All right. Live on Sunday morning. The Bet Out of That show. Patrick Doherty is in the house. I'm in the house. I'm Troy Johnson. Today we got a few topics we will be discussing. One, standard deviations. I had some questions about standard deviations, so Patrick is going to go into really good detail on what standard deviations are. And then we will talk about the exponential 200-day moving average and how that plays a part. And then Bollinger Bands to just kind of wrap it all up. Because when you talk standard deviations, the Bollinger Band is really based on that principle of volatility. And so, Patrick, are you ready? It's
Yes,
your
I'm ready.
show today. You ready to do this?
I'm ready to do this.
Okay, let's start the show. So Patrick Doherty, a resident accountant for a prestigious accounting firm out in Los Angeles. Let's talk standard deviation. And
Yes.
I was surprised because we talk Bollinger Bands quite a bit. We talk standard second deviation high, second deviation low. And much to my surprise, behind the scenes, it became apparent to me with some of the questions that people are confused. What is a standard deviation and all of that? And I even had family members who were confused by it that follow the show. So I want to go into detail and have you go into detail. You're a mathematical type to explain what is a standard deviation and just show us the curves, and then we can just go from there on how we use statistical values to increase our probability of making money. So I'm going to open the show up, Patrick, with what is standard deviation? What is that?
Okay, well, standard deviation is a measure of volatility above or below the mean. And it's based on the normal bell curve. And let me share the screen to explain this. So give me 1 second.
Okay. Now,
So I'm sharing the screen right here.
okay. Yep. I see you there, Patrick. Let's pop you up. Okay.
Okay, great. So this is the normal bell curve. So this curve will in pretty much cover 100% of the data that's out here. Um, the mean is obviously, the halfway point between all this data. And the standard deviation is basically three intervals of volatility here. Are the three uh, measures above the mean or three measures below the mean?
Let me
And
interrupt
that
you
will
real quick. So, some people may not know this word mean. What does it mean?
mean is just an average of data over a period of time. It could be 20 days, it could be a year, it could be 2 years. So it's essentially you're looking at a bunch of data, and you're basically calculating the observations within that data to get some kind of consensus of what that value should be about that data. Make sense?
Yeah, so let's say stock prices. Let's use data stock prices because that's what this is referring to. So
Yes,
you have,
exactly.
and so the mean would be the average price the stock would typically like to trade. Uh,
Yes.
let's say some other numbers. Let's say temperature, weather, right?
Yes. Yes.
What's the average temperature in the spring? That the temperature typically would like to be daily. I
Hmm.
shouldn't say like to be, is daily during the springtime. That would be the mean, that average point where that data set would typically be. Is that a good
That's
characterization?
that. Yeah, that's a very good picture definition.
So in looking at this curve, we have the mean in the middle of the bell
Yes.
curve.
Right.
And so let's go standard deviations from working in the middle, working out.
Okay. So the first standard deviation between the first between the first standard deviations, be it above the mean or below the mean, roughly 68% of the data is going to be within the first standard deviation. And again, standard deviation is a measure of variability within a data set.
So in terms of stocks, if we're talking about standard deviation for stock prices, and we say a stock, but what we're talking about the price of the shares of a stock,
Yes.
and we were talking in terms of standard deviations, the mean in terms of trading stocks, the mean is typically stock prices like to trade around the 20-day moving average, right?
Yes. Yes.
So that mean in the middle will represent the 20-day moving average. So whatever the 20-day moving average for a stock is, it typically is that mean. Stock prices typically trade around 20-day. And what is 20-day? There's 5 days in a week, 4 weeks in a month. So a monthly average of the stock price, right?
Exactly.
So if we were one standard deviations away from the mean, the average where it trades monthly, then you would say what without first standard deviation? What is that saying?
Okay, so if you're talking about if stock prices trade, let's say above the mean, you know, basically you're talking about taking this whole data set of within the 68, sorry, within the standard deviation here. So basically, roughly 34% of the time, the stock will trade above a mean, and roughly 34% of the time, stock should trade below the mean.
You were digitizing a bit. I think I heard you said 68% overall above and below the
Yes,
mean, meaning
yes,
34% above and 34% below. But as a data
right.
set, 68% of the time, the stock is going to trade, or the price or the data will be between
Within,
that range of the average price where it trades. So there is a 30% chance it would be outside of that data point.
yeah, yeah, roughly 31% of the time.
Right. Right. So when I say outside of the data point, can you point to that so it's clear on the screen?
So again, this is the 68%. Yeah. So outside of this would be here, would be here. So here, this is rather here or here.
Correct.
It would be roughly 31% of the time the stock price would trade outside of that 68% um, with within the first standard deviations,
Okay,
and
we're
that's
gonna
where you
go.
go into.
Yeah, so we're gonna go into this. So let's go, and right now it's still confusing, I'm sure to some, but we're gonna make a point here. So stay with us. So one standard deviation is 68%. We know generally, statistically, data would stay in this range if a data set is at that endpoint. So the key is at that endpoint. So if it's at the -1 SD or the +1
Yes.
SD, then we know that there is a 68% chance that it's going to be within that range. But there's also about 30% chance it's going to be outside of that range. But the further the data set gets away from its mean, the more we could predict where it's going to be, because it's getting further and further away from where it trades or likes to be on average. So let's look at this second data set.
Okay, so now we're looking at the second standard deviation. So now this is roughly 95% of the data within a data set will trade within this area underneath the normal bell curve.
So yeah, you're making a big loop there, Patrick. So yeah, so that minus 2 SD and the
Yes,
plus 2 SD got a 95% chance. If a data set reaches those extremities at
exactly.
the minus 2 SD or the plus 2 SD, based on the way that data behaves on an average manner, it should fall in between. So if it's way on one extreme, there's a 95% chance that it's going to go back towards the average or the other extreme, but it should trade within that data set. It's really too far from its average. So what does
Yes.
that say outside of minus 2 plus 2 standard deviation, outside of the data set, outside of the curve of that standard deviation? What is that also telling me, Patrick?
That means outside of the second standard deviation intervals that, you know, basically if a stock price trades outside of those two standard deviations, you're talking about very, very extreme volatility and will have a 90, if it's, above 95% chance of reverting back to the mean.
Wow, that was a mouthful. What about on the low side?
On the low side here, so let's just say that, the stock is down, and it's hitting above the second deviation, it would have a 95% chance or greater of falling back to the mean. So if it's on the low side, long explanation short, it would be a good buying opportunity.
Yeah. And we should use the plus as high and we should use the minus as low, Patrick, and we can flip
Okay.
the curve to the left.
Yeah.
So,
Okay. We can do
right.
that.
So
So then let's just say that the stock price is trading above the second standard deviation. That means it should fall. It has a a greater than 95% chance of falling back to the mean. So then that would be considered overbought in
right.
this, second standard deviation. If it's above the second standard deviation, if it's below the second standard deviation on the low side, then that would present a great buying opportunity if you have like one of your favorite stocks, like maybe Salesforce or Nvidia or Adobe or Disney.
And yeah, and what we're using is statistical analysis here. So this is the statistical curve. So let's point in at 95% there, Patrick. 95.5%.
Yes.
So, it's going to fall between those two curves. So let's go 3 standard deviations, Patrick. That's even
Okay.
crazier.
Well, that's very extreme. I mean, stocks rarely trade three standard deviations from the mean. So if in these cases, that would have to be like an exogenous event, like an outside event, such as the COVID lockdowns of
But let's
2020.
talk in terms of just what standard deviations means. Let's keep with that theme of data set. So it's 3 standard deviations, please.
So 3 standard deviations means that 99.7%, so basically 100% of the time, or near, the data set would be within 3 standard deviations.
Yeah, so 99.7. There still is a point 0.3, Patrick. There's a point 0.3 for a reason. That means something still could happen
Yes.
0.3% of the time. And it does happen, right?
Yes. So you're talking about like an extreme black swan event.
Right. So the key is understanding the probabilities of knowing how far you're away from the average price of a data set. And in knowing that, we can use puts and calls, or we could purchase or sell stocks at particular prices based on knowing these statistical analytical data points. So let's focus in on the second deviation, because that is what we talk about a lot on the show, and that's what we're gonna go into further in the show. So let's go right to the second deviation, Patrick. You can point there on those extremities.
Yeah. So second deviation, one here. So second above, second and two below.
Can you come up? Can you come up, please, too, on it? No. I'm just like move the cursor. Yeah, all the way up the line. Can you? Yeah. Yep. So those are the
Okay.
second deviations, right? So
Yes.
why would that be important, Patrick? Why would it be important? And why do we use the second deviation in stock pickings, statistical analysis with trading stocks? I would say the reason why we do not use 3 is it rarely happens.
Yes.
Why we do not use 1, it happens too often.
Right.
So 2 is that sweet spot where when your stock prices or your data set gets to either 2 to the minus, which is second deviation low, or 2 to the plus, second deviation high, we have a statistical advantage knowing that on placing trades or getting into a particular stock that we like, or getting out of a particular stock that we like. We also have another advantage of, if we want to do just a trade, selling puts or selling
Yes.
calls, or buying
Yeah.
puts or buying calls. Go ahead, Patrick. What would you say about that?
Yes. So what you'd want to do is that there's a the indicator which is based on the the mean. Second deviations would be the Bollinger Bands.
Correct. Correct. But let's before we go to the Bollinger Bands, and the Bollinger Bands is really based off of this. It shows the second deviations. We talk about it all the time. But I really want people to picture this curve in their mind and look at that minus SD, the second deviation low, that plus SD, the second deviation high, and think about it. Now, what if we, Patrick, took this standard deviation curve with the mean in the middle, being the 200-day moving average if we're using stocks? What if we took that and reverted over and turned it like the point on the top, tilted towards the left, and flipped it over? We'll basically have a Bollinger Band, wouldn't we?
Yes, we would.
So if we
Exactly.
had the cone on the top and we flipped it over towards the left, and we had this thing sticking up, we would have the second deviation high. Up above the plus 2SD, we would have the minus 2SD on the bottom. And that would be
Yes.
our Bollinger Band. And so if we were selling puts, what's the strategy behind selling puts, my friend? If we were to flip this thing over, and we'll show you the Bollinger Band in a moment. If we were to flip this curve over, then you would see that if we were selling puts, the strategy would be to sell below the second deviation low.
Yes.
And statistically, we know that 95% chance is going to be between the minus SD, 2SD, and the plus. So we only have like a 5% chance that the stock price or the data set is going to fall below. And that's what we want, because we sell premium and collect premium. And then there's an expiration date. And if the contract expires worthless, we get to keep the money we collected and have no obligation to do anything. Because when you sell puts, you have the obligation to buy if it falls below your strike price. So you sell at a strike price below the minus 2SD. And when you collect the premium and you collect $1,000, and a week later, if the stock is not below that strike price, below the minus 2SD that you sold, you get to keep the premium with no obligation to buy the stock. You just made $1,000. Did that make sense, Patrick?
Yes. Makes
And so
total sense.
that's what we do with selling puts. On the plus side, can you point to the 2 plus side right there? When the stock price is way above its mean and trading at the plus 2SD, well, we sell a call above the 2SD, between the 2SD and the 3SD. And we would sell that call maybe a week out, a month out, or whatever. And the strategy is same as the put. We sell the call, and what we want to happen is the expiration contract to expire worthless, so that we do not have the obligation to sell the stock at that strike price.
Buy the stock, you mean?
Buy the stock at that strike price. So, so what we do is sell above it so that the contract expires worthless. We get to keep the premium, and we walk away with contracts that expire worthless. So it's a worthless contract expiration game. Now, there's other things you can do with this type of probability trading as well. That is, what if you don't want to be a trader? What if you just want to be a person who long-term invests? Then you can also use this probability trading and thinking as well. But go ahead, Patrick. It sounds like you want to jump in.
Yeah, so let's just say that you're not interested in buying and selling options. That might be a little bit higher than than your risk tolerance. And what you could do is you could look at this. We could look at the Bollinger Band, which is essentially a graphical representation of the normal bell curve. And then once the stock trades below its second deviation, that would tend to indicate a great buying opportunity. And then if you're lucky enough to buy a stock cheap, and the stock is now trading above the second deviation, and you might think it's a little bit pricey, maybe the market's a little bit frothy as well, that might be a good time to sell the stock, take some money off the table, and then if it reverts back to the mean, then that might be, you might want to buy it back, perhaps buy a little bit as it comes down.
And so, and when it comes to buying stocks, trading stocks, things of that nature, we don't have to calculate where the second deviation is. Why not, Patrick?
Because there's a graphical presentation of this stuff on the Bollinger Band.
Right. This is exactly what the Bollinger Band is. The Bollinger Band is that minus 2 SD and that plus 2 SD already done for you.
Yes, indeed.
And so based on that, we can show you some things. But Patrick, before we go to the Bollinger Band, let's talk about the exponential 200-day moving average and how that ties into this as well. Because, you can be standard deviation high, you could be 2 standard deviations low. And what I meant, 2 standard deviation high, 2 standard deviations low. But if you 2 standard deviation high and 2 standard deviations low on a mean that's going down, that's not good. So why do we think that exponential 200-day moving average is important?
Okay, well, to me, the 200-day moving average, especially over a longer period of time, let's say a 5-year chart, would indicate if it's pointing upwards, that's an upwards trending stock, and that the 200-day moving average is a benchmark for that longer term trend. If that's sloping upwards, that means the stocks should be trading in an upwards fashion. And if the stock trades consistently above the 200 period moving average, then that it's a sign of strength.
So let's start to show some examples here. Now that
Yes.
we have showed the chart here, and this is a good chart, we should. I think I'm going to put this chart on the thumbnail for this show, so that
Exactly.
yeah, it'll be a good one. So let's go and show some examples, Patrick here.
Okay, so let me flip to a new screen.
Okay, and then let's go with your new fave. We always talk tech stocks, but let's talk Eli Lilly. Let's
Yes.
talk a medical play, a
Okay.
pharmaceutical. So, all right, Patrick, let's get the Bollinger Bands out of there, and we'll
Yep.
bring that back. Let's let's keep it simple. Okay, so what are we looking at here, my friend?
So right here we're looking at a 9-month line chart of Eli Lilly.
Let's go. Let's go best practices. Let's go 5 year. You want to work your way out in.
Yes.
All right.
So best practices would be start with the long-term trend first. And again, this is Eli Lilly. This is the famous drug company, and they got a good diabetes drug. So, anyways, this is the 5-year trend of the 200 period moving average of Eli Lilly. And as I was discussing earlier, this is an upwards trending 200-day moving average. And I think that's very quintessential that
Now,
that
what is the
remains.
200-day for those who are new? Which one is the 200-day moving average? You're making an assumption that people know which one is the 200-day moving average.
Okay, the 200-day moving average is the bold red line. That's the 200-day moving average. And again, it's the moving average of the last 200 periods.
Yeah.
That's a graphical representation of that.
Yeah. So what does that mean? That means at every point that you see as you go back in time, that point represents 200 days of closing prices for this particular company's stock divided by
Yes,
200.
exactly.
So every point is 200 days in the past. So
Yes,
the closing price 200 times divided by 200 from the previous day. And then it just goes back, and it plots that chart. We're using the exponential. It smoothens out the curve from wild volatility swings. So, and the key is that the stock price of any company that you're plotting the 200-day moving average or the exponential in this case, you really want that stock to do what, Patrick?
you want that stock to be above the 200-day moving average.
And then where's the stock? Let's make sure we're not making any assumptions. So where's the stock?
It's currently well above its 200-day moving
And
average.
what's representing the stock price?
It's this black line here.
Thank you. So
And this
if you could,
black line is consistently above its 200-day moving average. I
gotcha.
mean, there might be the odd period it may kiss it or just momentarily go below it, but that's usually like, they're very unusual. If the stock is or the company is a strong company and is reflected, that strength is reflected in the stock price, as it is in this case of Eli Lilly. Sure what happened here.
Yeah, you clicked out. It's easy to click back or pull it back up.
All
So
right, let me go forward.
just click back in, Patrick. Good
And which I
enough.
thought I did.
So yeah, so that is why we want to show this, and we'll tie it together. So we just talked about standard deviations. Now we're talking about the exponential 200-day moving average, and how do you pick the right companies for trading, for or investing. And the further you are above that exponential 200-day moving average, meaning the further the company stock price, represented by the squiggly line, is above, the more it's growing, the better it is. And you can see in this case, Eli Lilly is well above. But this is a 5-year weekly chart. So each plot on this chart represents 1 week of average closing price for Eli Lilly. So long term, you want to look at the 5-year for any company, and then you want to dial it in from a long term 5-year 200-day moving average to a like 1 year to 9 month to get a more recent view. And that's going to switch the frequency from, and let's go point to the frequency up there, Patrick, please. That's going to change the frequency
Daily.
from weekly to daily. Can you circle that, Patrick, so that people can?
Yeah, right
Yep.
here. Right
And
here.
go back to 5-year. It automatically does it. So you'll see that the frequency automatically goes to weekly. So each plot on that chart represent a weekly data point, a weekly average price plotted. So now let's go back to 1 year. Let's do 1 year, Patrick. Let's do
Okay.
9 month. 9 month is good as well. That's going to show a daily frequency. And you want to make sure that your stock price stays above that exponential 200-day on a shorter period of the same graphical plot. So what are we looking like here, Patrick?
Well, this is on the 9-month chart, and it's always above the 200-day moving average on a 9-month plot. So,
And go ahead.
so this is the 200-day moving average here, and again, it's sloping upwards. And then this black squiggly line is the average of those are the actual closing prices.
The daily closing prices of Eli Lilly, the stock.
Right.
And then if you were to go down on the x-axis, you can see, the months. So we're not talking in terms of years. You can see this is the course of 9 months. So the charts are really great for, just a quick look to see if you have a growth stock. And we keep covering the same things over and over so that it will sink in. This is super, super important. This is the basis of technical analysis and picking the right stock. And Patrick, you always talk about the exponential 200-day moving average pointing up versus pointing down from left to right.
Yes. And then what I could do is I could show an example of a stock that trades down. And this is something you may want to avoid.
No. That's not. Let's stay here, Patrick. Let's stay here. Let's stay here for now. I don't want to confuse the audience. All right. So we taught standard deviations. We taught the 200-day moving average.
Yes.
All right. The standard deviation was talking about probabilities. The 200-day exponential moving average is talking about picking the right stock for that probability. The next thing we will talk about is the Bollinger Band, picking the right moment to get into that stock that you put all of this work in for the probability thesis. So add in the Bollinger Band, please, Patrick. We went from what a probability is to picking what we're going to use the probability on to executing the probability. So let's go there on Eli Lilly. So you add in the Bollinger Band by going to studies and moving average exponential. And now Patrick has added the Bollinger Band in. What are we looking
Yeah.
at here, sir?
Okay, so this is the Bollinger Band is based on the 20-day moving average. So the Bollinger Band is obviously based on the two standard deviations up and two standard deviations down. As you can see right now, the Eli Lilly and I guess and much of the market is trading well below the average of the Bollinger Band, and it's hitting the lower standard deviation here.
Super,
So
Patrick, I wish you would make bigger circles.
yeah,
Like when
right
you,
here.
yeah. Go ahead.
So right here,
Mm-hmm.
and then right there. So this would represent a potential buying opportunity because it's trading at the second standard deviation below the 20-day moving average, and at the same time, it's staying consistently above the 200-day moving average.
Right. So let's unpack that a little bit. Now let's blow this up a bit. Let's go 3 months so that the resolution on the screen would be larger. Please,
Okay,
Patrick.
so 3 months. There you
Yeah, let's go
go.
3 months so it closer. Okay. So now we have a bigger graphical representation here. So
Yeah,
let's zoom in on the Bollinger Band itself. Let's not make assumptions. Okay?
okay, so zoom in. No problem.
No. Let's focus. Sorry, I used the wrong word. Let's focus on the Bollinger Band
Okay.
first. Now, the Bollinger Band, there is a middle line.
Mm-hmm.
Go point to the middle line, my friend, please. And
Yes.
trace it, please, with your cursor. Yeah.
Yeah.
Hopefully people can see that because all of the lines are moving, but there is a top line of the Bollinger Band.
Yeah, which is this here.
I wish you would have started from the left just like you started before, but that's fine. You're moving pretty fast. I think people get it. And there's a bottom Bollinger Band.
Okay. Which is
Now,
this here.
what do they represent? So rather than trying to figure this minus 2SD plus 2SD out, the Bollinger Band does it for you. The top line of the Bollinger Band shows you the plus deviation high. The middle shows you the mean, and the bottom shows you the minus 2SD. You are looking at a standard deviation curve graphically plotted on the chart. And it's even shaded for you to say, this is where the stock should trade 95% of the time.
Right.
So I'm looking at Eli Lilly in between the Bollinger Band, and you can see Eli Lilly is down, and you can see the price. Go point to the price there, Patrick. The price right there is 245. It's the black there, but he just covered it. But yeah, it's right there at 245. It's at the bottom of the Bollinger Band. It's on the second. It's at the minus 2 SD of the standard deviation plot. And it 95% of the chance it's going to be below or up. So we know it's probability wise it should go up. At some point it should go up because it's too far away from the middle, which is I think that's 258. So why is that important? If I wanted to make some quick money and do a short-term trade, you see that 240 down there, Patrick?
Yes.
Point to the 240. I'll sell a put right there, Patrick.
Exactly.
I'll sell
Yeah,
a put that expires in 2 weeks, I'll give that stock maybe a month. I'll give that stock an opportunity to bounce back up. Sell a put there for $2,000. And statistically, I'm below the minus 2 SD. The stock price should not get to 240 under normal conditions. I'm going to throw that out there. And so if my contract, let's say, expires next week, let's just use short-term expiration contract. I sell a put at 240.
Yes.
And I collect $2,000 for selling that put with the obligation that I have to buy 5,000 shares of the stock if Eli Lilly is below 240 next Friday, because expirations on puts are always on Fridays, right?
Yes.
Yeah, for those, right? So stocks, option expirations are Fridays, weekly. So let's say next Friday, I have sell a put that's going to expire next Friday, collect $2,000. I'm just laughing because when next Friday comes and Eli Lilly price is at 242, even if it falls a little lower, when the stock trading session closes and it's not below 240, I get to keep that $2,000 and do nothing. I no longer have an obligation to buy those 5,000 shares, and I'm happy.
No further commitment.
No further commitment. That's selling puts, guys. That's the selling put game. So Eli Lilly presents a great opportunity to sell a put. Now, why would I feel so confident about that trade? This is where the 200-day moving average comes into play. Point to the 200-day moving average down there, Patrick, please. It's at 227, right? And it's pointing up. So
yes.
What is this statistically doing for me as a trader? What this statistically is doing for me is saying this stock on average trades around its mean, which is the middle line. It's actually the 20-day moving average. That's what the middle represents. But the point is, on average, this stock goes up in value. So if I go out in time, statistically,
yes,
this stock should go back towards the middle or second deviation high and up, because the 200 moved, because the stock just consistently stays above the exponential 200-day moving average. So that's why I feel comfortable about this trade. It's a upward trending stock that's below its mean trading position. And I'm selling below so that the contract can go worthless and I can collect money with no obligations. So
exactly.
That's it. That's the put selling game. So the second thing that we talked about earlier, Patrick, was we also talked about buying. Where would you like to buy? Would you like to buy high or buy low? Would you like to buy anything high or low?
Yeah, you don't want to buy high. You want to buy low.
You absolutely want to buy low. You sell high, but you buy low, right? So
yes,
let's say, for instance, I wanted to be an investor in Eli Lilly. And I'm saying, okay, I looked at Eli Lilly. It's a great company. It consistently stays above the exponential 200-day moving average. It has a pipeline of all of these new drugs coming out. That's why you like it, Patrick. We talk about this stuff off camera.
Yes.
Now, I just want to buy the stock. I don't want to do all this option selling, and I don't understand it and all of this. I just want to buy the stock long term. Well, in looking at this, you would say, hey, Eli Lilly right now is trading at the second deviation low of the curve. So this is a great time to buy it, because it's the exponential 200-day moving average is telling you long term is this stock price is trending up in terms of data set. And I want to buy it at a point where it's on the low portion of its volatility. And
Exactly.
because that's what all of that squiggly line is as far as stock prices. Stocks prices do not just go straight up. They go up with volatility, up and down, up and down, up and down. And unless you have some sort of metrics of these types, it's hard to see, on a short period, a daily or weekly basis, if all of that volatility is actually going up over time. But with these kind of tools, you can see right at a daily period that this stuff is going up over time. So I can look at the second deviation low, Patrick. I can say, oh, this is a great opportunity getting Eli Lilly. It's on a minus 2SD. I'm going to
Hmm.
purchase me 50 shares here. So before I purchase any stock, I make sure it is at least in the middle of the Bollinger Band, at least in the middle on the 20-day moving average.
Yeah,
My
you don't want to buy up here. You don't want to buy up
You
here.
definitely don't want to buy at the plus 2SD. That is
Yes.
the point. So I that's a mouthful. I hope that stuff made sense to our audience. I really do. So so I hope so. Did that make sense, Patrick?
That made total sense.
Okay. And I have a question in the chat. And the question is, why exponential 200-day instead of the regular 200-day, Patrick?
Well, you want to do the 200-day, the exponential moving day, because it will give greater weight to the more recent data figures, and it will smooth out better. It'll better smooth out the extremes of a data set. So it'll place more weight, and it's a better representation of the trend as a result.
Yeah, that's it. You could have a large swings earlier in the year. The exponential 200-day moving average put more weight on more recent activity. It,
Yes.
and and not the simple. You can use the simple on 200-day moving average. Some people use that. I typically don't use the simple 200-day moving average because I want more recent price action based on more current news, current fundamentals to play more of a part of my plots than what happened 6, 8 months, 9 months ago. I want the stuff, of in the last quarter or two. And so
Yes.
that's what the exponential 200-day moving average. But if you want to apply to the whole year and take all of that in account, use the simple. But if you do research, most pundits, big word for experts, they say use the exponential 200-day moving average as well. Hopefully that answered the question.
Very good
So
question.
yeah, and if guys, if you like what you hear, if you learned something, hey, hit the like button, and let us know. This topic came up because of questions. I wasn't aware that people really did not understand this, deviation stuff, and we talk about the Bollinger Bands quite a bit. So hopefully the Bollinger Bands make a lot more sense. Hopefully the way we explained the moving average makes a lot more sense. And hopefully you have a better sense of how to get in a trade. Hopefully. What else, Patrick?
And yeah, I mean, just you know, I guess in a nutshell, this is this is the graphical presentation of buy low, sell high.
That's what it is, my friend. That's exactly what it is. And so, the stock market was crazy over the past week. I was certainly pretty active. Patrick, I got to ask you a question, though.
Yes.
What happened to your DocuSign? I've been riding
Oh,
you over DocuSign for about 3 months, a quarter now. What happened to your DocuSign over the past week?
oh, it got crushed,
What does that mean?
meaning that it lost like almost 50% of its value because the earnings are not so strong,
Interesting.
and the
Interesting.
guidance was very weak. I mean,
Interesting.
however, I did put out a disclaimer that it's a risky stock. I'm not, and you know, only risk money that you can afford to lose.
Yeah, and you know, I,
I thought it was a good bet for a small amount of capital.
yeah, you guys can go look at some of the past shows on DocuSign. When we initially started talking DocuSign, it was at what price, Patrick?
It was at $310 a share.
What is it trading at right now? It's way low.
One, yeah, 135.
It
So
went
less than
went
half
from
its value.
310 to 135,
Yes,
and I was expressing an inflationary environment
yes,
and why you should be cautious on DocuSign. And it was trading at a price to earnings ratio, a multiple PE ratio, whatever term you want to use, they all are the same thing. It was trading over 200 forward
yes, it
PE.
was. Yes, it was.
And now, what is DocuSign trading on a forward PE? I looked it up, Patrick. Would you like for me to share my screen?
I have it here.
Let me share my screen. Oh, you have it?
Yes.
Okay, hold on for a second. You want to pull that up?
Yeah.
You DocuSign fell from over 300 to 135, almost out of the hundreds. And you
Yeah.
have to see the forward PE on this. And we talked about this forward PE stuff last week and those ratios. So this should resonate with people a lot better now. Look at the forward PE. Can you circle the current forward PE of DocuSign?
This is it.
It's still $114. I mean, sorry, 114 times its earnings.
115 times. Yeah. I mean, but I mean, it came right down from over 200 to about 114. Exactly.
That's not good, Patrick.
No, it's
In
not.
this inflationary environment, and what is the inflationary environment? When the 10-year note yield is projected to go up, then the market values stock more. How? I would say they tend to want to go towards value stocks, and growth stocks with high multiples times its earnings get punished. And I saw that back 3 months ago. And so, yeah, DocuSign was at over a 200 PE. And it looked like a great company. It took off on us. And I was like, no, Patrick, I can't go with a 200, over 200 times earnings. It has fallen from 310 to 135. It's still 115 times or 114.94 times earnings. And it's still expensive.
Yes.
But what did we talk about last week? You cannot just look at the PE alone. You have to look at its growth rate. So if you really look at its growth rate, it's really, DocuSign is not expensive, actually. That 114 PE, forward PE, is justified. Patrick, can you go over to analysis?
Yeah.
Go over to analysis and go to the bottom and look at its projected 5-year growth rate and growth rate next year. And you're going to have to pull your screen over a little bit to the left. If you can pull it to the left
There
a
we
little.
go.
There we go. All right. Look at that. So DocuSign is projected to grow. Look at that, Patrick.
The current year, 88.9%.
Yeah.
Next year, 28.8%. Next 5 years, 46.8%.
46.8% of per annum over the next 5 years. That's big growth. So, 114.9 PE. That's kind of justifies 2 times the growth rate. It's kind of justified, but still,
It's very expensive.
it's still a little expensive. You know what scared me, Patrick? Once you put CRM, I have some trades on CRM. I would have sold CRM before the earnings if I would have known this. I looked at the valuation and I said, "Oh my God, I'm in an overpriced stock." and the valuation looks terrible. Check it out. Look, go to statistics, please, and look at the forward PE on CRM. Are we on CRM? Can you go?
We're on CRM. Yeah,
How do
forward
I know?
PE.
Can you go to the top, please? There we go. Salesforce. There we go. All right, $258 a share. Check this out. Go and look at the forward PE.
Forward PE. Okay,
God dang it, Patrick. You all over the place. Stop it. You're getting me seasick. All right.
Yeah, I just got to make sure I have the right number.
Yeah. So the forward PE, the multiple, 56 times earnings that's projected to come up next quarter. Okay?
Yes.
56 times earnings. That's big, right? Look at the PEG ratio we talked about last week. 3.46. Look in the past. If you just go back towards the past, it's a little cheaper than the past, but still pricey in this environment. But it gets worse. It's only 10 times sales. Only 10 times sales. But that PE of 56.8 is a little scary. So I was like, oh no. So I hopefully the growth rate will justify a high PE. Again, guys, I like to be at a PE no more than 30, below 30 actually. And and below 20 is even better. So when I saw that 56, I started freaking out a little bit. Now, Patrick, go over to analysis, please, and look at the growth rate over the next 5 years is projected. And I'm hoping there was an error, because then I really started freaking out on this. Go to the bottom, please.
All right.
Oh.
Okay, so the growth estimate.
Look at that.
So next year is 1%. Next 5 years per annum, 10%.
Is that good, Patrick?
No, it's not. No, it's not. I mean, the S&P 500 usually grows at around 11 to 14%.
That's not good. I might be in a little trouble on that CRM trade. And
I know I sold my CRM at a couple of days ago.
Yeah, my CRM got cut. That they reported earnings and they disappointed on the guidance, and the stock price got cut a bit. It fell, and I'm just looking for an avenue to get out of CRM. I do not like those metrics. It could be wrong, but why be in a trade like that when you don't have to? There's so many other good companies out there where you don't have to do that type of thing. You know what I mean?
Exactly.
Yeah, so why carry that risk when you really don't have to carry that risk? I mean, so it's like carrying a risk on a Lucid or one of these other EV plays. It could be a small percentage just for speculation, but I typically like to go with the sure thing, so.
Yeah, me too.
All right, Patrick, I think that's about it. You want to wrap it up, or you got something else to say?
No, I think that's good for now.
Okay. All right, Patrick. So that was the Bet Out of Debt show, and hopefully you enjoyed what you heard today. Hopefully you learned something. And if you did, hit the like button, share with your loved ones. Let's teach our babies this financial literacy. I'm Troy Johnson. We call this show the Bet Out of Debt show because when you place a trade, it's just a metaphor for placing, we call it placing a bet, but it's just a metaphor for investing. And hopefully it's a winner one to keep you out of debt. And as always, keep investing, and we will see you next Sunday. Take care and have a great weekend.